All right, let's talk about a term you've probably seen 1,000 times if you've ever looked at stocks, the PE ratio. But what does it actually mean? Well, today we're going to break it down because this one little number can totally change the way you think about investing.
So, to get started, I want to ask you a question. Real simple. Let's say you're looking at two different stocks. Which one of these looks like the better deal to you? Okay, so you've got Tech Giant Inc. on the left, trading for a cool $1,000 a share. And on the right, you've got Startup Co., sitting at just $10. Now, your first instinct is probably to say, well, Startup Co., obviously, right? I mean, it's so much cheaper. It's got to be the bargain.
But here's the twist. What if I told you that the share price by itself is probably one of the most misleading numbers in all of investing? Seriously, it tells you almost nothing about the real value of what you're buying. To figure that out, we're going to need a much smarter tool.
And that's because so many of us fall for what's called the stock price illusion. It's the super common trap of thinking that price and value are the same thing. But they're not. A $1,000 stock isn't automatically expensive, and a $10 stock is absolutely not guaranteed to be a bargain. It's all about context.
So how do we get that context? Well, this is where our hero, the PE ratio, comes in. I want you to think of it like a relative price tag. It's the tool that lets us ignore that big, flashy share price and look at what really matters, how much profit the company is actually making.
So what is it? Well, the PE, or price-to-earnings ratio, does exactly what its name says. It compares the company's stock price to its earnings per share. And earnings per share is just a fancy way of saying the company's total profit divided up by all the shares out there. It's the go-to metric for getting a quick snapshot of whether a stock might be a great deal or maybe a little overpriced.
And you know what the best part is? The math is incredibly simple. Seriously, you just take the current stock price and you divide it by the earnings per share. That's it. Price divided by earnings. See? No crazy calculus required here.
Okay, a quick but important detail. When we say earnings, there are actually two main types you'll see. There's the trailing PE, which is like looking in the rearview mirror. It uses the real, actual profits the company made over the past year. It's fact. Then there's the forward PE, which is like looking through the windshield. It uses predictions of what analysts think the company will earn in the future. So one is based on history, the other is based on a forecast. Both are useful, but it's good to know which one you're looking at.
All right, enough with the theory. Let's get our hands dirty and see how this thing actually works in the real world. This is where the light bulb really goes on.
Okay, check this out. We've got two companies here from the energy sector. Marathon Petroleum trading around $160 a share, and Hess Midstream at about $41. Now, if we were still stuck in that stock price illusion, we'd say Hess is the bargain, no question. But watch what happens when we use the PE ratio. Suddenly, the story completely flips. Marathon has a PE of about 23, while Hess has a PE of just over 15. And you can see that difference plain as day right here. Think about what this means. Even though Marathon's stock price is way higher, investors are actually willing to pay a much bigger premium for every dollar of its earnings. That lower PE for Hess Midstream tells us that when you compare price to profit, Hess is actually the cheaper stock. Isn't that wild? It's the complete opposite of what the share price alone would make you think.
So, if you remember one thing, make it this. The PE ratio tells you how much money investors are willing to shell out right now for just $1 of that company's profit. In our example, people are paying $23 for $1 of Marathon's earnings, but only about $15 for $1 of Hess's earnings. That's the real comparison.
Now, as a general rule of thumb, a high PE often means the market is really optimistic about a company. Investors expect it to grow like crazy, so they're willing to pay a premium today for those big profits tomorrow. On the flip side, a low PE could mean a stock is undervalued. Maybe it's a hidden gem the market has overlooked. But, and you knew there was a but coming, right? It's not always that simple.
Yeah, because for all its power, the PE ratio is not a crystal ball. It has some pretty significant blind spots. You really have to know what it doesn't tell you before you can use it effectively.
First off, if a company isn't making any money, it doesn't have a PE. Can't divide by zero, right? So for a lot of new startups, it's a useless metric. Also, and this is a big one, you should only use it to compare companies in the same industry. Comparing a tech company to a bank using PE is like comparing apples to, well, car engines. It just doesn't work. It also completely ignores debt, and it's only as good as the numbers the company gives us. So yeah, powerful, but you gotta know the limits.
And that's why it's so critical to think of the PE ratio as just one tool in your investor toolbox.
You wouldn't build a house with just a hammer, right? Same idea here. The PE is a fantastic place to start your research, but it should never, ever be where you stop.
And there are plenty of other tools in that box. For example, there's the price-to-sales ratio, which is great for those companies that don't have profits yet. You've got price-to-book, which looks at a company's hard assets. And there's a really neat one called the PEG ratio, which cleverly factors in the company's growth rate to give you an even clearer picture. Each one tells you something different.
So, when you boil it all down, what's the big idea? The PE ratio isn't some magic answer key. It's a lens. It's a tool that lets you see past that shiny, distracting stock price and helps you start asking smarter questions. It shifts your thinking from how much does this cost to what is this business actually worth. And that shift, that's the first real step on the road to becoming a much smarter investor.